Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Craig Martin. Craig is a certified financial planner. His company is the Family Wealth Consulting Group. They are fee-only financial planners. They provide asset management services. They've been doing that for, I guess, about 31 years, right, Craig?
Or longer, yes.
Oh my gosh. Anyway, and he's the author of a book, Craig Martin on Asset Class Investing, and I'll bet if you wrote to Craig, he might even be willing to send you an autographed copy. So anyway, his wife is trying to get all this stuff out of the closet. Anyway, we've been going through an interesting time. Today is September 6th of 2011. And I can't quote you statistics, but I can tell you that it is September 6, 2011, and the market was down, I guess, another couple hundred points today.
Wow.
And we have been through a pretty good roller coaster, mostly downward for the last month, mostly as a result of our Congress having some difficulty in extending our debt ceiling initially, and then Standard & Poor's was rather unhappy with them and gave them docked their debt rating as far as how creditworthy. I mean, we're talking about the United States government here. If they're not creditworthy, we're all in trouble.
Yeah.
And so anyway, and let's face it, we've had some tough times in the economy and so forth. So, I mean, things were going pretty well in the stock market. I think we didn't get over like 15,000. I don't even know if you remember, Craig. And now we're down like around 10,000. And
we're just under 11,000 probably. I didn't look at the closing number today before we got on the air.
Yeah. So it's kind of discouraging, and so
we're going to talk about that emotions.
Right.
All those emotions that generates.
Well, that's right.
Yeah.
So I asked Craig to join me today. We talked about this topic before, but I think it's time to revisit it. Actually, it's a good idea to revisit it every year because let's face it, folks.
Very topical.
Yeah, we're calling it investing in turbulent times, but the fact is that the stock market is never really stable. You're always going to have some movement that's going on. That's just part of the game. That's part of what we're going to be talking about. And so I asked Craig to join me today and talk about it as an asset manager. And so, Craig?
I'm real glad to be here, Mike. You have built a real legacy of recordings of some of the best financial people in our community.
Thank you for that.
And I'm real proud to be a part of that list.
Thank you very much. And we're going to be actually going into Craig's community. So this is kind of exciting. He'll actually be able to be on cable in Morgan Hill, I believe.
Yeah.
So that's going to be kind of cool. All right. Well, Craig, let's get into some of these questions. So here we are. I'm an investor. You're an investor. You're investing for other people.
Lots.
Okay. With a volatile stock market, should I just be sitting on the sidelines?
Well, it's easy to look at the stock market and say, I hear it frequently from clients or prospects of mine who say, well, when the market gets stable, I'll get into it. Well, the truth is, market's never stable. You said that earlier. Mm-hmm. The way we say it is, sometimes it goes up, sometimes it goes down. Mm-hmm. Nobody knows when or how much. Mm-hmm. So it's very difficult to predict that kind of thing. First slide that I have, if the viewers can see that, is called the cycle of market emotions. And what it shows is how, as the market goes, so when you buy, you're hopeful that the market's going to go up. So as it goes up, you get increasingly excited. And as the market gets higher, you're very excited about the results in the marketplace. And then it starts to go down, and you're a bit apprehensive, but don't do anything. And then it goes down a little bit more, and boy, you're watching it more and more closely. And then it goes down even more, and that's when people sell. Mm-hmm. So people are greedy on the way up and fearful on the way down and panic at the bottom. Mm-hmm. If you can show the second slide, it's called Investors Motivated by Fear and Greed. And what it shows is that in the middle bar, that if you had bought and held the stock market for 20 years, any 20 years would work, but that slide ends in '06.
Yes.
That you would have earned the returns of the marketplace. By the way, it's interesting to look at that number. It was nearly 12%
Yes.
per year.
Yes.
If you just buy the S&P 500.
Right.
The average investor, because of their emotions, earned only 4.3%, almost a third of the returns of a simple buy and hold. So what they're doing, what the average investor is doing is what that chart showed. They're buying high and selling low, which is the opposite of investment methodology.
Yeah. Well, let's just say it's the opposite of what we say that you're supposed to do. You know, we say, you know, buy low and sell high. That's the idea, and unfortunately, our emotions lead us to do just the opposite in so many cases. Yeah. Okay. Well, golly, should you disregard your emotions when making investment decisions?
You're human. It's tough to do that. It's human. The mistake would be to use your emotions to make investment decisions, because as humans, we're not programmed to have emotions that give us good investment choices. We spent many millennia living in the field as hunter, warrior, gatherer, whatever, and our brain works to protect us in that environment. Our brain is not programmed yet to protect our investment portfolio. So the slide that I've got is called Stay the Course, if the viewers can watch that. Notice that this period ends in 2008. That's a 20-year period ending in 2008. And the S&P 500 went from an average of 11.8% per year to an average of 8.4%, which only points out the recession that we went through in '07 and '08. Yeah. And the average equity investor was earning 4% just a couple years earlier, now earns less than 2%. Again, a quarter to a third of a simple buy and hold. You know, if you look at the next slide called the impact of missing the best 10 days in the calendar year in a 20-year period, this particular slide ends in '07, and what it shows is that the top line demonstrates if you stayed in the marketplace, bought and held 100% of the time, never sold out, and the bottom line says, whoa, on Tuesday morning I think I'm going to get out of the marketplace and go back in on Wednesday. And it turned out that Tuesday was the best trading day for that time frame. And if you did that 10 times, got out on the best day and right back into the market, your returns would have been significantly less. So it's about half the returns. That's a significant loss of principal, simply because you couldn't hold on to the marketplace and stay in it.
Okay, so let's take a little break here from the slides and stuff, and because notice though that we're talking about long periods of time, and a lot of people think of short-term moves in the marketplace.
Yes.
And when you and I talk, and you're giving presentations, quite often you'll use the phrase "over your lifetime." And so, so I just wanted to focus on that for a moment, because the point is, I think, and particularly as we watch what's happened, you know, again over the last month and so forth, and how do we respond, is that that many people think of the market as short-term investment and so forth, and the fact of the matter is that when you operate in that way, then basically you've come to the casino, I think. Whereas when we're talking about long-term investment for things like retirement and funding our children's education and that sort of thing, then we have to be thinking more in this long-term mode and thinking more like 20 or 30 years. And then when we operate in those types of time frames, things can become a little more predictable. Not totally, but a little more. So maybe you'd like to comment on that a little bit?
Sure. The term was predictable. So over our lifetime, the market has returned close to 10% per year.
Yes.
In some lifetimes it's been 11, in some lifetimes it's been 9%. Mm-hmm. But it has never been 2% over someone's lifetime, and it's never been 20%. So the safe thing to predict is that if you buy and hold the stock market, you'll earn the returns of the stock market, of course, because by definition you own the stock market, and those returns will be real close to 10% in a 3% inflationary economy.
Mm-hmm. Okay, and so again, part of what we're talking about, I've got it here somewhere to some degree, but what it really boils down to is this, that the volatility of the stock market is the reason for the return. In other words, we're being paid for sitting through all that stuff and enduring.
Yes.
Okay.
Yes. So the way to endure that volatility of the stock market is to not watch it, because if you could invest today and hold it for the rest of your life, and the day before you die, we take a look at that portfolio, you will have earned close to 10%, because that's what the market produces. Mm-hmm. Okay, it is a free return in the stock market.
Craig calls it a free return because, well, it just sort of happens, but it's out of our sweat of our brow, folks. So it's, in a sense, nothing is free, but in a way, that's the payback that we have because of the volatility of the market. Mm-hmm. And so that's what we need to understand. Is that's why we're getting paid that risk premium. Okay, well, let's go back a little bit to our slides now. And so the next question is, should the average person invest in the stock market?